As a successful investor who has built a $1.1 million portfolio, I'm often asked for advice on how beginners should invest their first $10,000. In this comprehensive guide, I'll share the exact strategy one would use if I were starting over from scratch. Remember, investing is a highly personal endeavor, and what works for me may not be the best fit for your individual goals and risk tolerance. However, the principles I'll outline have proven effective for building long-term wealth, regardless of your experience level. The 4 pillars of a balanced $10,000 portfolio. When it comes to investing your first $10,000, I believe the key is to create a diversified portfolio that balances growth, stability, and income. To achieve this, I would allocate the funds across 4 main categories: S&P 500 Index Fund, Tech/Growth ETF, Dividend-Paying Stocks/ETFs, Cash Reserves. Let's dive into each of these components in more detail. 1. S&P 500 Index Fund. As a beginner investor, I would allocate around $3,000 to $4,000 of my $10,000 into an S&P 500 Index Fund. The S&P 500 is a stock market index that tracks the performance of the 500 largest publicly traded companies in the United States. By investing in an S&P 500 index fund, you're essentially getting exposure to a diversified basket of blue-chip stocks that have a proven track record of weathering economic storms. Some of the top companies in the S&P 500 include household names like Microsoft, Google, Amazon, Visa, Costco, and Waste Management. These are the honor roll companies that have demonstrated their ability to generate consistent profits and returns for investors over the long term. When it comes to choosing an S&P 500 index fund, there are several great options to consider. Personally, I invest in the SPDR S&P 500 ETF, ticker SPY, as it is the most heavily traded and liquid S&P 500 fund on the market. However, there are other excellent alternatives like Vanguard S&P 500 ETF, VOO, iShares Core S&P 500 ETF, IVV, and Fidelity 500 Index Fund, FXIX. The key is to pick one fund and stick with it, rather than trying to diversify across multiple S&P 500 trackers. All of these funds provide exposure to the same underlying index, so there's no need to overcomplicate things. 2. Tech/Growth ETF. For the growth-oriented portion of my portfolio, I would allocate around $3,000 to a tech-focused exchange-traded fund, ETF, like the Invesco QQQ Trust, QQQ. This ETF tracks the NASDAQ 100 index, which is composed of the 100 largest non-financial companies listed on the NASDAQ stock exchange. The NASDAQ 100 is heavily weighted towards the technology sector, with companies like Apple, Microsoft, Amazon, Nvidia, and Meta Platforms, Facebook, making up a significant portion of the index. By investing in QQQ, you're gaining exposure to some of the most innovative and fast-growing companies in the world. It's important to note that technology stocks tend to be more volatile in the short term, so this allocation should be viewed as a long-term investment. If you're someone who can't stomach the ups and downs of the market, you may want to consider reducing your exposure to this sector. As an alternative to QQQ, you could also look into the Invesco NASDAQ 100 ETF, QQQM, which offers a lower expense ratio for investors who don't need the higher trading volume of the flagship QQQ fund. 3. Dividend-paying stocks/ETFs. For the income-generating portion of my portfolio, I would allocate around $2,000 to dividend-paying stocks or ETFs. Dividend-paying companies are often considered more stable and less volatile than their growth-oriented counterparts, as they tend to be well-established businesses with a history of rewarding shareholders. One of my favorite dividend-focused ETFs is the Schwab U.S. Dividend Equity ETF, SHD. This fund holds a diversified basket of high-quality, dividend-paying companies across various sectors, including Pepsi, Coca-Cola, Home Depot, and Waste Management. Investing in dividend-paying assets serves several purposes in a portfolio, provides a steady stream of income, which can be reinvested or used for living expenses, offers more stability during market downturns, as these companies tend to hold their value better, helps to balance out the higher volatility of growth-oriented investments. While dividend-paying stocks and ETFs may not experience the same rapid appreciation as tech companies, they can play a crucial role in building long-term wealth and generating passive income. For cash reserves. Finally, I would allocate around $1,000 of my $10,000 portfolio to cash reserves. This may seem counterintuitive to some investors, as holding cash typically doesn't generate significant returns. However, maintaining a cash cushion serves an important purpose in a well-rounded portfolio. Dry powder for market dips. Having cash on hand allows you to take advantage of market downturns by deploying funds to buy stocks at discounted prices. Emergency fund. Your cash reserves can act as a safety net in the event of unexpected expenses or job loss, helping you avoid having to liquidate investments at inopportune times. Flexibility. Cash provides the flexibility to quickly take advantage of new investment opportunities as they arise. If you're using a brokerage account like Fidelity, you can even earn a decent yield on your cash reserves by having it automatically swept into a high-yield money market fund. At the time of this writing, Fidelity's money market fund was yielding around 4.9%, a nice return for the boring portion of your portfolio. Putting it all together, sample $10,000 portfolio allocations. Now that we've covered the 4 key components of my $10,000 portfolio, let's look at a few sample allocation scenarios. Balanced approach. S&P 500 Index Fund. $4,000, 40%. Tech/growth ETF. $3,000, 30%. Dividend-paying stocks/ETFs. $2,000, 20%. Cash reserves. $1,000, 10%. This balanced approach provides exposure to the broad market, growth-oriented tech companies, and income-generating dividend payers, while also maintaining a cash cushion. It's a good starting point for most beginner investors. Growth-oriented approach. S&P 500 Index Fund. $3,000, 30%. Tech/growth ETF. $5,000, 50%. Dividend-paying stocks/ETFs. $1,000, 10%. Cash reserves. $1,000, 10%. This allocation skews more heavily towards growth, with a larger stake in the tech-focused NASDAQ 100 ETF. This approach may be suitable for younger investors with a higher risk tolerance and a longer time horizon. Income-focused approach. S&P 500 Index Fund. $4,000, 40%. Tech/growth ETF. $1,000, 10%. Dividend-paying stocks/ETFs. $4,000, 40%. Cash reserves. $1,000, 10%. This portfolio allocation places a greater emphasis on income generation through dividend-paying assets. This approach may be more appealing to investors who are closer to retirement or those seeking a more conservative investment strategy. Remember, these are just sample allocations to get you started. As you gain more experience and become more comfortable with investing, you can adjust your portfolio to better align with your specific goals and risk tolerance. The power of diversification and consistency. Regardless of the exact allocation you choose, the key to building wealth with your first $10,000 is to remain diversified and consistent in your investment approach. Don't try to time the market or chase the latest hot stock or sector. Instead, focus on building a well-rounded portfolio and contributing to it on a regular basis.